Thank you, Mr. Chairman. Mr. Bordia, in your testimony, you discussed the need to have a wide variety of options for moving mortgage credit risk into the private market as opposed to limited options. Could you explain the reasoning for that a little better? I assume that if we're too restrictive in the options that market participants have to satisfy private capital requirements, we would risk diminishing the appetite of the market to move private capital into the market. But could you explain that dynamic a little better?
I think I'll refer to some of the things that I mentioned in the previous, in answering the previous question. So if you're trying to insure close to $5 trillion worth of mortgages, then you need a lot of capital. We've seen about $1.8 billion of sales in credit-linked notes from GSEs this year, and they were massively oversubscribed. But to assume that you can go next year and sell 15, 20, or $30 billion of that kind of those kind of notes, I think it's practically not possible. So the main reason when I say that, you know what, we need to look at multiple options is because there is a limited amount of capital chasing different kind of assets. On the fixed income side, we have about $850 billion of non-agencies still outstanding. And those non-agency securities have about $60 to $70 billion in paydowns. And to the extent that a lot of those investors have mortgage credit expertise, you could assume that some part of that $60 to $70 billion comes into the marketplace. But if you try to do anything more than that, it is going to be complicated. Then there is also another set of investors on the equity side, which can basically, where you can also raise money and do something using the bond guarantors.
Thank you. And Mr. Palmer, you indicated in your testimony that there are a number of regulatory, tax, and accounting, I guess I'll call them barriers. I don't know if you used that word, but it sounded to me like that's what you were saying, to effectively creating the necessary instruments and risk management procedures that we need to engage in. Could you elaborate on that a little bit?
Sure. We spent quite a bit of time working on the structures that we came to market with this year, and I think over the course of the 2 years that we worked on it, we definitely ran into a number of regulatory issues, and either proposed or new rules that have come out. A couple of key ones that I want to mention that I refer to also in my written testimony is, we refer to the transactions that have been done as credit-linked notes. They were actually, in fact, not credit-linked notes. They were debt offerings of the GSEs, and that was because a new ruling that came down under the CFTC in 2012 that would have deemed these type of credit-linked notes as commodity pools. We've engaged with FHFA and with Fannie Mae in conversations with the CFTC to ensure that we can be fully compliant with those rules, and we hope to ultimately move to a more traditional credit-linked note. The importance there is that right now the structures that we're doing, investors are taking counterparty risk to the GSEs. Moving to a credit-linked note, you capture all the cash up front in a bankruptcy remote trust, which protects both Freddie Mac and the investor from counterparty risk. So we think it's an important thing to move to in this credit-linked note structure. Second, we think it's important for these securities to have, call it, equal treatment from a tax and a regulatory as others. So there's been some discussions here about a senior subordinate securitizations. There's some pros and cons there. One of the key cons is the lack of compatibility relative to the TBA market. Investors today that invest in a senior subordinate security are able to get, they treat it as a REMIC, which has more favorable tax treatments under that rule, and having a credit-linked note that is structured in a way very similar to a senior subordinate, having similar tax treatment for investors, both domestic REITs or the common investors as well as foreign investors, is important to note.
All right, thank you. You identify some problems in getting through the complexity here, but it's important that we get it and get it right. Mr. Durant, the last part of your testimony this morning or this afternoon related to the necessity that reform be comprehensive in the sense that, if I understood you right, we need to be sure that all loans are subject to the same capital requirements. Could you expand a little bit on your comment there?
Sure. Clearly, you have to think about the capital that's required for loans that are held on balance sheets at banks versus within S1217 is a 10% subordination level equivalent to a bond guarantor being required to be capitalized to a 10% level. Clearly, those aren't the same things. More importantly, I think we also have to also think about FHA, VA, and Ginnie Mae, and how does all of this interact with FHA financing in particular. The changes we make to the rules around a government guaranteed section replacing Freddie and Fannie clearly are going to potentially drive loans back into FHA, VA lending.
All right, thank you.